The merchant funding is going to take a percentage of their sales, and it's going to be at typically it's between a 6-month to 14, 15-month payback period. It's a relatively quick payback, and that's going to range between anywhere from 10 to 30% of their daily credit card receipts is going to be the return. Okay, so the difference, to get into a little more nuance here of what's different about our program than the competition when it comes to the merchant program, typically, and you'll see this in the recently funded transactions samples, what we try to do is to either lower the cost of the money or I should say or reduce the amount that's taken out on a daily basis, and also stretch those terms out if need be. So where someone may be paying back, let's say they got $100,000 and they're going to be required to pay back $130,000, what we'll see a lot of times is our competitor will have them at a 6-month payback, let's say, or a 4-month payback, and they're pulling 20% or 25% of their daily receipts every day. Well, that can be a pinch on their cash flow. So we could take that same prospect, and instead of taking 25%, we may only take 12% per day, and we also may stretch them from, if it was 4 months, we may stretch them out to 8 months. Now, they still may have to pay us back $130,000, but because we reduced the percentage and increased the time, it really helps their bottom line and helps them, it helps their cash flow. Another example is if it's a seasonal business, and I know in the Northeast, let's say the summer season is coming. You may have someone out there at the beach that's got a big season for 3 months. They make really all their money in that 3-month period, or most of it. Then we would take a much higher percentage of their receipts during that 3-month period, and then scale it way back over the shoulder seasons and the off seasons. So just different things like that. We found our competitors just typically don't do that. And the merchants really appreciate that flexibility, because it allows them to continue to operate and make money like they're supposed to.
So basically, a business may be able to pay the money back over a longer period of time, and that may help them get through a season where they really need the cash, like through a holiday season, for example, or something like that. Or maybe maybe the tough times through the summer and the holiday seasons when they pay it back.
Yep. That's right.
And the reason for that is because we've got investors who are putting their money in, and they're not eager to get their money back in 30 or 60 days necessarily. They're willing to wait longer because they want their money out longer to make a higher rate. Is that correct?
That's correct. That's right.
Okay.
And we've been getting them a very good return.
Yeah.
They're very happy. So. Yeah,
that's very cool.
Yeah.
That's really cool. So let's get so there's merchant account or bank account funding. There's a line of credit that can be gotten on top of an existing loan, and there's a purchase order financing. If they have a purchase order from a bona fide customer, we can advance them as much as 100% of the purchase order amount.
Right.
Yeah, this is the kind of funding that banks should be doing, but they're not. And I'm not sure they're ever going to be doing it again. It may be years before they're back in this business. So
I don't see it. Yeah, I don't see it coming back for a long time.
They really never liked it. And one of the options that people have here is they have credit cards, their own personal credit cards or business credit cards. Remember, business credit cards typically are personally guaranteed by the business owner. They're not really loans to the business.
Right. I want to make one other quick point, too, on the difference. On the merchant program, one thing that we'll do as well is we will fund on top of their current balance, if it's our balance. If it's a new client coming in and they have a balance outstanding with a competitor, we'll pay that balance off and give them the money that they need. But they don't have to pay that current balance off with us if they need another advance, which is completely different than our competition as well. And a lot of our customers like that. They really appreciate the idea that they can actually get another advance because they may very well need it, and they don't have there's maybe a certain thing that prevents them from being able to pay it all the way off before they go get another advance. So that's one thing that we'll do also. It's very helpful.
Yeah, how many people avail themselves of that?
Most of them.
Okay.
Yeah, I mean, really, that's one of the key factors of our program. That's
So
separate.
if you need more money, we can actually do another loan on top of or another advance on top of the existing advance quite often.
Right, and just also keep in mind that also means another commission to you if it's your deal. So it's a good thing to promote.
Yeah. So let me just ask you to explain how the funding works, the merchant funding, so we really get it. Because just kind of go through it slowly if you could.
Okay, sure. So let's say that let's take it from the very beginning. You have a client that needs some working capital. And I'll try to think of a specific example. We've got a client right now that we're talking to that's been in business. They have found another location and they'd like to expand into that location. They need to do They need to do actually a build out in that location. So they're looking for some capital. They went to their bank, couldn't get any money at their bank, and they've applied with us. We've actually gotten them approved, I believe, for $25,000 on the first advance. Now the amount they needed was a little more than that, but what we're going to plan is we're going to advance them one time, get them going, and then we're going to advance them again so that they can achieve the amount that they need. So essentially, we reviewed their current business and their current receipts. Underwriting came back and made the offer at $25,000. What will happen now is they'll get funded directly to them into their account $25,000 when the funding occurs. So they have a check, they have money. Now they can use that money for anything they want. Hopefully they're going to use it for what they said they will, but there really isn't any, there's no covenant that they make with us that they have to use it for, the set purpose. They can use the money really for any purpose. What will happen then is we've filed a UCC on their business assets, and that allows us then to take a portion of their credit card processing on a daily. It's essentially a daily withholding or withdrawal. So and then there's an agreed upon amount. So if it's $25,000, and I'm just going to use rough numbers, a typical number here, the factored amount was 1.3. So they've agreed to pay back $32,500 on the $25,000. That's spread over, I believe, 12 months at 10% of their daily sales. So what will happen is 10%, if they sell $1,000 at their restaurant today, $100 will be swept into our account until they pay back that $32,500. And that's a daily sweep or daily withdrawal from their current account. There's no prepayment penalty. They wanted to pay that off early, so to speak. I mean, there really isn't one. And again, they can borrow on top of that balance once it's been paid down a little bit. And that's kind of a case by case, and it's approved by underwriting. But it doesn't take any time to get that approved, typically. So that's it. I mean, it's a pretty simple process. They get approved, they get the money. We take our money back through the processing of their credit card receipts, and they can get more if they need it.
Okay. Does the company do we process their credit cards for them then?
Well, the answer that we give our clients is no. We don't have to replace. We like to. We would prefer to, but it's not a requirement. So if you're asked by your client, do I have to switch processors? The answer to give is no. And typically we'll discuss that with them at the time of funding. And again, it's not a requirement, but it's a preference that we do. And if it makes enough sense for them, typically they will switch over. But the actual answer is no, it's not a requirement.
Okay. Okay. So Well, let's see who qualifies, the kind of qualification process for this, now that I get it. So maybe you could take us through this, because this is a real biggie for me.
Well, who qualifies is really anybody, any small business that's doing some level of transactions. We can do startups, but if you think, I mean, it's so vast, it's hard to really kind of put it into a box here. Any business that's doing transactions, typically the ones that we see are somewhat undercapitalized. They're having a hard time finding money at the bank, so they are looking for a way to get capital at some level. They don't have collateral. They don't have to own real estate. It's different than commercial lending in that sense. There isn't equity. They're not looking at equity. Typically, credit is not really an issue. They don't have to have great credit. They're businesses that, frankly, are struggling at some level, and they need some capital. They need help, and a lot of times it can mean the difference of surviving and not surviving. That's really what this targets. We do a lot of work with franchises. I think we mentioned that earlier, but franchises are a great one for this, and we find a lot of franchises utilize this program for expansion. A franchise owner might have 5 stores or 10 stores, and they want to move into another location or 2 or 3 locations. They'll use the money to move on that way. We've done a bunch of Subways that way. We do a lot of Dunkin' Donuts, things like that. So it's really somebody that's in need of capital and cannot get capital at the bank, I guess is the best way to say it.